unable to share. So feel free if you want to record.
Recording has begun for people that can't make it, and yeah, you're also going to share your slides. So thanks so much, Arden.
Okay. Well, so for the benefit of everybody who is just only seeing the recording, two parts, right? One, I'm going to go through an overview of what due diligence, things you want to think about and things that investors want to see. And then the second part is I'm going to actually go into a mock investment committee presentation. That is what I would actually show my investment committee in order to get an approval. And that's kind of the difference between, angel investment and fund investment. A fund investor is not going to be the one typically making the decision on their own, unless maybe it's a VC with, like a small shop with one or two partners. Generally for venture firms and most funds, they're going to have a committee, like Panache Ventures does, we do, that way the manager doesn't fall in love with the deal, the one person on the team, and it's actually vetted thoroughly. It's business case analysis, right? For anybody who's done that in school. As a little bit of hygiene, I'll probably, stop to take a bio break after about 45 minutes or so in case anybody needs it. I probably will. Just so there will be a break. And I encourage you to turn your cameras on if you like, because then I can kind of see the reactions and what's hitting with you and what's not. If you're camera shy, that's fine. I mean, I can only see 20-ish or so of you, but it makes the experience a little bit more interactive for me rather than talking to a wall of names. So there we go. Nice to see all your faces. Look at that. Hey, okay. And with that, I am going to get things going and share my screen. Put this into presentation mode. All right. And assuming I need to hit the share button. There we go. Yes, I can use technology. All right. So, of course, calling this giving diligence its due. And I mean, really, when you look at what due diligence is, it's just research, right? That you take in order to make sure you're comfortable with the risk before you purchase something, right? Normally, the word due diligence is associated with a legal requirement, but in our case, it really comes down to making sure that we've made the best decision possible, having analyzed whatever we're looking to invest in. Right, so you've decided to raise capital, now what? Okay, number one thing I always tell entrepreneurs, or I try to, is start a data room. Now, what is a data room? It's where you're going to actually hold all these documents that an investor is going to want to see. So the last thing you want to do is get into due diligence. So what the process is going to look like, you're going to be talking to some investors, and eventually, luckily you may find a lead investor, okay? And this is, probably going to be around where you're raising, anywhere from $750,000 to $2 million, we'll say, because that's when you'll get more of a formal investor, like a venture investor involved. You might not go through all this detail when you're just kind of doing a friends and family round, but at the same time, the sooner you get prepared. One of my associates, Dave Edmonds, always says, as soon as you start signing documents, throw them into a data room so that you have everything captured and you're not scrambling to look back a year and a half, for paperwork afterwards for something you may have signed. And so a data room's easy and it's free, right? You can use Google Drives, you can use Dropbox, but set something up and you'll see. There's certain buckets and certain categories that are pretty common, but it's up to you how you want to organize it. The main point is the last thing you want to have happen is to go into a meeting with an investor and they say, okay, let's get the due diligence. And you go, okay, well, what do you want to see? And then you just email stuff and put them into attachments. That's kind of a no-go because as you'll see, there's a lot of documentation. The very least you want to do is show them, okay, I'll get you a link to our data room. And, anything that's missing, let us know, we can put it in there. And it's nice and organized. And whoever's doing the due diligence can just go in and access without emailing you and phoning you and trying to get this stuff. This certainly speeds up the process and makes it easier. So again, this is an example. This is the actual, there's 2 pages here, the checklist of things that I will go through when I'm doing due diligence on a company. And like I said, these PDFs will be available to you so you can actually see. But these are the broad categories we look at, and not all of them may apply depending on the stage that you're at, right? When I look at the valuation, public comparables might not be as applicable. There might not be any private transactions analysis available because of the sector you're in or whatever it is. But this is the comprehensive list and we kind of whittle it down. You'll notice there's a legend there where I'll actually put this table into my presentation to the investment committee. And if it's, in red, it might be it's still in progress, we haven't finished it yet. And if it's in gray, it's not applicable. It's just, uh, but to cover, the broad areas, we want to understand the market, the technology, and the strategy. All of these can either be individual documents, or a lot of times what I'll see from founders is elements of these all incorporated into the business plan and the pitch deck, right? When you get to this point in due diligence, you'll probably want to have a business plan and not just a pitch deck, because we're going to see some detail. So, it doesn't matter if these are all separate, as long as I can find this information somewhere and I can check it off, right? Again, over the legal side, we're looking at the technology, your IP. We want to review your financials, understand your management and personnel documentation and that sort of stuff. And the form this all takes is I'm either going to incorporate actual documents into my investment committee, or for the most part, I'm going to be able to say, I've addressed this. I've seen it, I'm comfortable with it, it's available in a data room. But all of these points that are relevant need to have been touched upon, right? And I have to know that I'm comfortable with all these points.
Hey, Arden, we just got a great question from Mike on this slide, which is,
yeah, please.
At what point do you open up the data room to potential investors? And do you need to ask them to sign an NDA to see your data room?
I've never been asked to sign an NDA to see a data room. When you're getting into due diligence with an investor, if they're formally in there, like that's their commitment to actually do the work, right? And they will actually say, at least for a fund anyways, and say, okay, we're going to go into formal due diligence. Might be different with an angel investor. I wouldn't put anything into your data room the truth is the way investors typically look at NDAs is if you can't, there are some exceptions, don't get me wrong. But if you can't explain stuff to me at a level that doesn't require a non-disclosure, it's kind of questionable as to, do you really know your business well enough, all right? Or the value of it, or being able to explain it. And one of the challenges especially for venture investors in signing NDAs is we see so many deals. And, we'd have to get our legal team to review every single NDA. We would have to, and the potential for, quote unquote, potential conflicts, it's just too much of a hassle. And 98% of the companies we look at never ask for an NDA. So, why? The question is, why does the investor feel motivated to sign one then at that point, right? So my advice is, if you find a way to present your information in a way that doesn't compromise the integrity of your company. And once the investor is, basically ready to commit and all they need to see is that last document, then maybe you can start talking about NDAs. But I wouldn't open with that. Hope that answered the question. And again, that's
the first part of the question was like when to actually open up the data room to the investor. But
sorry,
my understanding was you kind of said the investor will ask for it, so it's kind of on them.
Yeah. Essentially, have it ready for whatever an investor asks for it. But I would, at the same time, I wouldn't just, because your financials and stuff are going to be on there. I wouldn't just open it up casually to anybody who's just like, oh, well, we're thinking about it, we're not sure. You should very definitely communicate and even, get it by email in writing. Okay, we are interested and we are formally going into due diligence. And that's how I would handle it, right? Because that means, okay, we're taking the next step. This isn't just everything before that shouldn't require a data room, and that's the pitch deck, that's a meeting, that's some interviews, some talks. The due diligence portion is when the investor is ready to actually sink. I'd say on average, I would put, depending on what's available in the stage of the company, anywhere from 12 to 20 hours into due diligence for an early stage company, right? So that's a significant a portion of my time spread out over a couple of months to work on it. I'm not going to just casually go into due diligence with every company that may be interesting, right? So in our deal flow, there's an actual qualification where you're either a lead, a qualified lead, or in due diligence, there's stages. So yeah, maybe not necessarily. I would say the time to open it up is when it's agreed upon that the investor is going into formal due diligence with you. So some high level stuff in no particular order, but things you'll want to kind of think about and cover, make sure you have available. A venture investor is going to want to make sure that you're for real, right? You're incorporated. So you want to have your minute book up to date, right? It's going to have your articles of incorporation, your minutes, directors meetings, stock certificates, all the legal stuff. It's easy right from the start just to make sure all that's organized so you can hand it over or show it to an investor. You don't want to be scrambling to put these documents together, 2 years after you've incorporated. So again, just examples of some of the things that you can put into a minute book. So easy to get going from the start, and to maintain as you go.
Arden, I want to ask a question about that because I know like it sounds like, oh, this is mundane, everyone needs it. But I'll admit that like when I was first trying to build a company, I actually found the concept of like having this organized minute book and all these documents somewhat daunting, and like running a proper shareholders meeting and document. I don't know, like I didn't really know exactly how that was going to work. So do you have any suggestions on where to get started for a new entrepreneur that's like, okay, how should I do this professionally?
Yeah, I mean, if you're just getting a company started, you're probably not going to have a formal board of directors. I would say you probably shouldn't have a formal board of directors. So you're not necessarily going to have, formal. I mean, you may have directors and such, and your meetings will actually. Let me back up here. You're not going to have outside directors, right? You as a founder may be a director. You and your co-founders will be directors. And your meetings really could be just, we had a coffee. We're going to take a note and just say, we had a meeting on this date. You can backdate it, whatever. Just have some record that the directors met according to whatever your bylaws indicated, quarterly or whatever it is. Here's what we discussed. And it can be like 3 sentences, right? That's not so important. It's like when you get outside directors that we want to, see records of decisions that were made at the board level. So if you don't have those like if it's, I say that's less important. What's going to be important is like your articles of incorporation, right? Knowing that you are actually a real company. We'll usually have our legal team review the minute book, but the point is to show proof of life, right? And that you're actual, we can legally invest in you. So I would say focus on that. You're probably not going to need to do a lot of recording of minutes and that sort of stuff until you actually get a formal board going. But at the very least, like I said, show that you're real. All right. Financials. First of all, we'll talk about historical financials. Even if you don't have revenue yet, right? We'd like to get some idea of what you spent your money on so far and how you spent it, where it came from. By the time you get investors coming in, it's highly doubtful you'll have had no revenue, whether it's grants, your own money, whatever. It's good, and it can just be a spreadsheet. I mean, we're not talking audited statements or anything prepared by an accountant, right? We just want to have some idea because it really tells us, the story of your company to date, right? How are you managing your cash? Are you able to service debt? Things like that, depending on, again, your level. Whatever you can put in is going to be helpful because it helps us as an investor to understand where you've been, right? And where you've been spending your money and how it's gotten you here. It should be, something that all entrepreneurs have a good idea of is what your gross and net burn rates are estimated to be. So your gross burn rate is overall how much are your expenses every month overall, and net is what's the result after you take into account revenue, right? We want to kind of know how much cash is going out the door. So if you're telling an investor, I'm raising $1 million, but we're burning through $1 million a month. That money was only going to last you a month, right? I mean, that's an exaggeration, but that's why it's important. We want to understand, what's the runway you're going to get yourself with. And if you have, a positive burn rate saying, we're actually cash flow positive already, that's an even better story, right? Saying we're raising this money for growth and not to make up for financial financial losses, which in some industries is entirely normal and acceptable. So I want to make sure that everybody understands what I say. Sometimes it's not an absolute. It's just guidelines in general. There's always exceptions. And now we're talking about your projections, looking forward, right? We want to see how you're thinking about the future. And you don't need to go, too far out, right? This is, what do you think your revenues and expenses are going to be? Because we want to get an idea, where's your business going and is it realistic? What's the potential? Now, there's, no need to go out too far in the future. 5 years, I would argue, is even a bit much. If you're going to do 5 years, it's really to show that, yes, there is the potential here. If everything went perfectly, this could happen. We all know that doesn't happen. It's more, I think 3 years is reasonable, and it's more for us to see how you're thinking about the business. Have you captured all the expenses? Is there anything you haven't thought about? Do you have a realistic allocation? I mean, if you are if you're a manufacturing company and I see 80% of your expenses allocated towards employees, we might want to have a look at, what does your cost base really look like? Is that realistic, right? And I would say, I always try to focus on what I call the year one revenue plan. And that is, I'll give you the best way to do this is give you an example. So if you're telling me that you think in year one, you're going to get $2 million in sales, what I'd want to understand and working with you on that is, okay, well, how many customers, based on your pricing, does that mean you have to reach? So, if it's, every customer is worth $500,000 to us, right? So that means we need to land 4 customers, but we think that we'll get through to maybe, 1 in 10 customers that we call will actually buy from us. That means I have to call 40 customers. And then you look at the market and go, well, there's 30 potential customers out there. Well, that kind of puts your revenue plans in jeopardy, right? So I want to understand how realistic is that sales plan and assessment of the market, because that's probably the most, I guess, the most accurate information you could get. I mean, closer in time, right? That year one. And if it's realistic, then you can build from there. And that's a test I often use to make sure that I'm comfortable with the forecasts. Because the last thing you want in year one is to be like, well, we thought we'd do 5 million, but we only did 500,000. That's a huge miss. But it's important for us to understand what your secret sauce is, right? What's the intellectual property if you have it? Whether it's patents, copyrights, trademarks, etc. And this matters to us because that it's about your competition, right? Is your technology easily copied or stolen by somebody? Because that could impact your reputation. You could lose income, which of course will then impact your growth and valuation, devaluing your assets. And international laws differ. So we want to know that you understand as you scale and grow how your intellectual property protection applies in different jurisdictions, right? So the business plan, right? Helping your investor to help you. One of the worst things you can do is not have a cohesive story about your business and what's going on, right? And we want to see a basic roadmap of how you got there, right? And where you're going to go. And that's the business plan. This is beyond the pitch deck now. Now this doesn't have to be a 50 or 100 page. And I would say it's a really nice to have. Not every company I've done due diligence on has it, but the ones that do, it certainly makes the due diligence process go faster. And, that's always a good thing, because then we can get you your money faster and get to the close. And I think something I want to emphasize is, treat your investor as a customer, right? And what you're selling them is your business model, not just your business, not your technology, the business model. So that includes, your assessment of the market, your financials, your forecasts, your revenue model, right? All of that. That's what you're selling me as the investor, not just we have this really cool technology that's going to solve a big problem. And I can't emphasize this enough, spell it out for them, right? In the due diligence phase, more is better. We always say in a pitch, keep it streamlined, keep it simple, tell me the high level story, get me engaged, because I see so many of these. But when I'm doing due diligence, I need as much detail as possible, because as you'll see in the next part of this presentation, I have to then tell the story to my investment committee, right? I'm making a business case from what you're giving me and my own independent research.
Hey, I actually just posted a sort of a thought, and I just wanted to get your impact on it. Yep. For the business plan, like I think I used to, at least like in academia, was taught like, oh, this business plan is this like 30-page document. And like, I think most people don't really like that. But what I've seen some companies do really well is they kind of break the key aspects of the business into like different components. And then they have like a 2 or 3 page summary of like, this is the HR strategy. This is the sales strategy. And like each one is just like a thing in the data room you can go to, as opposed to like.
Absolutely. I mean, I've seen very, very helpful and effective business plans that were like 10 pages long, right? 10 or 12. But the point is that you've put everything together, that you're trying to sell me, right? In one place. So I'm not digging around and trying to make up the story myself, right? Capitalization tables, I do entire presentations on cap tables, right? Ownership matters, right? Because we need to look at this. This is really how this represents ownership in your company, and it's a tool that you can use to model how this next round and the round after is going to go. Um, this, especially, new rounds of financing, and for an investor, like a venture investor, we use tools like this to model what our potential return is going to be. Because what I can do is take these iterations further into some hypotheticals and figure out what's our likely return going to be for the investment we make now, and how much do we need to put in follow-on rounds to get to where we need to be. So it's important to, capture, whether it's a spreadsheet or there's different software programs out there you can use, but make sure you really capture everything in terms of ownership in your company, right? Because I can't stress that enough. It's a lot harder to go in later and try to like add stuff, or try to find your certificates and figure out where the shares were, who owned what the terms were, at 2 or 3 years later. And your lawyer typically should put together a cap table for you if you're not familiar with how to. But it's, there's a lot of literature out there on how to do it. I have a basic template that I always, I'm happy to share with entrepreneurs. But it's certainly important. And again, we want to know things like dilution, right? So if I'm investing X amount now, and you as an entrepreneur want to know, like, with the next round, whatever is raised, what does that dilute your position to, right? We want to know who the other investors are, right? And how many there are, because that could have an impact on governance, for example. If you've got 25 shareholders and you haven't, and you're raising your seed round now, and you have to get, everybody to vote on a unanimous shareholders agreement, we know that's going to take some time, and we have to factor that in. But if it's just 3 of you, we know that we can make decisions pretty quickly. We want to know the effect of our investment on the current investors and, the entrepreneurs, right? And that comes back to dilution, because that's also going to matter in terms of how agreeable everyone is to the terms. Our interests align. Now, what that means is I'm, very sensitive to making sure founders have enough equity in the company as you continue to grow and raise. I worry about founders who give away too much of their company in the beginning, because you have to have enough interest in the company to make it through a few rounds of, if you're going to go on a venture-backed route, you're going to have ownership to make it worth your while, right? I mean, how motivated is as an entrepreneur if after they've done their Series A, they only own 10% of their company, and they've given away everything, and like there's not a lot holding you there. I want to make sure that they're well compensated and aligned.
Hey, Arden, Godfrey has a really good question here, which is, as we're talking about all this due diligence, kind of at a general level, what is the appropriate amount of due diligence for the stage that you're raising money at?
Good question. I think everything I'm going through right now is real world where and Accelerate Fund invests. And that's early stage companies. You've got a bit of revenue, and, anywhere from 100, 200, 1,000 and up to, I would say, even, $1 million. And you're raising, like I said, anywhere from $500,000 to $2 million, and you need money in order to start hiring people, do some marketing, and to really kind of prove out your market that it's a big one. You've proven that, okay, we think our technology works because we have customers that want it, right? And we're still doing everything manually, and we need to start kind of, creating some processes and ways of thinking around how we're going to grow. And that's, at that point, this is the stuff that generally a venture investor is going to go through. And I know, like, for example, over at Panache, Tim does a very, very thorough analysis. And typically their reports are like ours, it'll be 20 to 30 pages of information for their investment committee. So I would say when you're at that formal level, this is all going to be required. And so prepare for it. If you're, pre-revenue, pre-seed, you're raising a small round, maybe it's friends and family, you're probably not going to need this level of due diligence. And I think my purpose here is to show you what to expect when you get to this point, right? When you get to the Series A and B levels, that's an entirely different story, and our community isn't quite there yet. And when we get there, I'm sure I'll be doing more talks about that, in the next few years. But I think what everybody could benefit from right now is an understanding of when you get to that first, kind of early stage raise, right, where you're earning revenues and you need money to hire people and to continue your growth before the Series A. This is really what you want to start preparing for.
Okay, and then there's a follow-up question, which is, as on this capitalization table topic, are there some rules of thumb about how much money or how much of your company you should be giving away per round, or how much
Yeah, yeah,
dilution?
there's averages out there, and there's I actually have a chart. Like I'll send with this presentation when I get it to you, Zach. But I mean, there are studies around average dilution amounts per round. And I would say, I mean, by the end of the rounds that we do, the owners. This is actually based on an actual a real cap table. The entrepreneur, after they've done the round, going into the Series A. So before the Series A, on average, will own 60 to 70% of the company, fully diluted, right? That means including your options, option pool, and grants and warrants and such. And that should be enough to kind of withstand the next few rounds. The average is 15 to 20% of your company is what you're selling each round, right? Maybe a little less at the very beginning, but as you get into more mature rounds, that's kind of the average.
Okay. And then Mike asked a good question, which is, maybe you can just tell us from your own experience, how long does it take from you getting introduction to a company to closing the deal and actually investing?
That's a good question in that it's changed. Pre-COVID, I was kind of down to about, I'd say from the time I am interested in a company. Actually, I'll change that, because that's the time we're interested is a very, there could be a very long period or a short period. I would say from the time I start due diligence to the time we close the deal, I had it down to about 60 days, because we have to do, customer interviews, we have to do our research. Plus I have other aspects of the job I have to do as well. But that's also why we're hiring an analyst, in case anybody knows of a good person for the position. Little plug for Yaletown there. But now with COVID, we're all kind of trying to figure out how do we do deals remotely. And I think it's going to take more time. I think due diligence is going to can take upwards of 90 days, because we're going to want to spend more time talking to the entrepreneur. We're going to want to spend more time and do even more reference checks than we did before, especially if we've never met in person, we don't know them or their reputation, or have any kind of evidence of the work they've done in the past, right? If there's no relationship, then yeah, that's going to take a lot more work. And I think all venture investors, we're all trying to figure out, what does doing a deal entirely remotely look like in this pandemic period. So I'm going to say plan for a bit longer. And I think, it's safe to say 60 to 90 days, is what I'm kind of seeing. This last investment that I did, I got into due diligence and it took a little over 3 months, but actually it took closer to 4, but there were a lot of issues that we had to work through on the deal, and there were some complications, but we eventually got through. But yeah, 3 months I think is a good average, right?
So, but the first part of the question is like, how does a company get onto your radar and how to generate interest from you? So you're like, okay, now I definitely want to do due diligence. And I think you kind of hinted at this. It can actually be a pretty long timeline for that, because maybe you hear about a company at the very beginning and you're kind of watching them, and then you get excited about them at some point.
Yeah, and it can, it takes all forms. I mean, number one, if we're getting into this, then the pre-due diligence stage, venture investors have an investment thesis, right? And what that is here's our framework. Here's what we're looking for. Here's the parameters. And it's kind of a bell curve in that, we might be able to do a deal that's a little bit, on the smaller side or a little bit on the bigger side of the general curve we're looking for in terms of characteristics. Those characteristics can include revenue, valuations, and I'll talk a little bit about valuations and why they matter so much to us. And it's not about the value of your company or we're being cheap. It could be things like, what sector are you in, right? So my fund, Accelerate Fund, only does B2B. We don't do B2C, generally. And for certain, for reasons. There's the industries we stay away from, and there's industries we'll, generally want to invest in because of their scalability characteristics. So every fund is different. Every fund has their way. I guess in the investment world, we talk about we call it, this is how we look at the world, right? And part of that is driven by where are our networks, where are our expertise, and where can we be of value? It's hard for us to do, for example, a clean tech deal because I don't have a lot of contacts or background in that sector, right? Or any sort of network. So that's just as an example, right? So the way that happens is, you do an I mean, like for example, most funds have a formal application process, whether it's a form or an email that you attach your pitch to. It's getting in front of the investor, making sure that your company kind of fits into their investment thesis. And if it's not evident, look at the companies that are already in their portfolio. What kind of companies are they invested in? And see if you're somehow, analogous to them in any way, in some sort of characteristic. Or the easiest thing to do is ask, what is your investment thesis? What are you looking for? Because I'm looking to raise capital, right? And again, every investor is different. Some investors don't like cold calls. Some do. I'm always happy to take a cold call because I think if you're looking for the outliers, they can come from anywhere, not just from warm calls or relationships. But I do appreciate it when an entrepreneur has done their homework and knows, that what my fund invests in. The worst thing is when I get people reaching out on LinkedIn and haven't read first thing in my LinkedIn profile, I can only invest in Alberta startups, and they're asking me to invest in, a company based out of Dubai or Ireland. Well, that's a bit of a waste of time to get into a dialogue there, right? So do your homework and just get into the conversation. What I call is, if you can get to that next conversation where we want to spend an hour or two talking to you about your company, that's what I call a qualified lead, right? And then at that point, the team decides, okay, is there enough here for us to go into due diligence? So, the long and short of it is there's no one way. Get in front of the investor, show them what you've got, and make sure that, you've done your homework as to what they're looking for, right?
The other thing I think, well, sorry, just to one quick, I think unique point about your fund is that since you're focused on the Alberta tech community, and as you pointed, we're not a massive community. I feel like you probably have pretty good eyes on companies as they percolate through the system. Are you ever just like absolutely like floored and blindsided? Like, wow, there's this amazing company here that's totally investable. Yeah. And I had no idea they existed.
Absolutely. And okay. I love that. That's how it should be. Between me and my partners, Brad Johns and Dave Edmonds and the organizations we're involved in, I think we've got a bead on about 70% of the deal flow happening in the province. But there's a lot of companies out there who don't come out to these events or aren't necessarily part of the ecosystem, or just kind of, have been working off on their own and haven't really reached out to the community so we don't know about them. And it's nice when you see them because it lets us know that there's a lot of potential out there still and a lot of great things happening. So absolutely.
Okay, awesome.
The last point I'll make on this capitalization table is the implications of capital structure. And what that means is, understanding how the different kinds of capital you raise impact the ownership positions, right? So if you raise on convertible notes, if you have safes, having a cap table helps you model, if it's done right, what the effects are if you raise and everybody converts, or what happens if you have a flat round, and how does that impact everybody's, or even down round. So again, it's a very powerful tool that, I would say every investor is looking for and needs. Okay, $1 million-ish question, right? Pricing your seed round. Valuation of your company, and this is going to be part of the terms, right, that you're going to be negotiating, but it has nothing to do with the actual value of your company. What it's really about is about how much of your company you need to sell at this point, and how much the investor wants to own or needs to own for their investment. And I'm going to get into that a little bit more in the next slide. You're looking for expertise beyond cash. It's, we call it smart money. Now, generally, the earlier stage you are, the harder it is to find quote unquote smart money. And also depending on the industry you're in, if you're in blockchain in Edmonton, it's going to be hard to find investors that have expertise in that sector, right? So you want to look for expertise beyond cash. You want to look for investors that can open doors, provide guidance, and, help you expand your company beyond just writing you a check. And your price does send a signal to the investor and the raise of the math of the raise. I'll talk a little bit more about that in the next slide. And, be aware of down rounds, right? And the potential for tools that investors might want to put in place to protect themselves. Now, again, this is all part of the strategy of negotiating between the two parties. Because as we talk about in the valuation point, like part of it is for us managing the risk of getting from this round to the next. What are the chances you're going to make the valuation you're aiming for in the next round is what we're thinking about as investors. And that has an impact and influence on, what price we're willing to take now. And if you want a higher valuation, we think, okay, well, maybe that might happen. We might put in some anti-dilution tools to protect ourselves, like ratchets and such. I won't get into the details of those. I would say you want to avoid those if possible. The best thing to do to mitigate all kinds of anti-dilution tools, which basically state that if you don't hit the price that you make, we suddenly get a massive booster to our shares to protect our percentage, and you get diluted as the entrepreneur. You're going to take the hit for not hitting your numbers. And I think it's a better alignment if both parties are sharing the risk. And we'll talk a little bit about how you can do that as well. And, you know, not all exits are good exits to a VC, right? Know what the expectations are. I've had entrepreneurs come up to me and say, we're going to do a 10X in 3 years. And I look at that and say, that's not what I need for my fund, right? Great that you can do it. And there's, you know, the odds that you're going to get there are probably pretty huge, but that's not what I'm looking for my fund in order to, you know, get the returns I need from my investors. So make sure the expectations are aligned. And, you know, have some idea of what terms you're going to be looking for in your raise, which we'll get into the next slide, or at least be open to discussion. If you're not sure, start talking to an investor. Even like myself, I talked with lots of entrepreneurs who are thinking about raising capital, and, you know, you can read books on it. You know, Brad Feld's Venture Deals is a great one that gets put you know, gets circulated around. I'm always happy to have a chat, whether we're investing or not, about, okay, how do you think about your round, right? So, the importance of valuation, right? It really determines how much of your company you'll be giving away. And we talked about this already. You know, if you give away too much up front, you're really not having much left over for as you get to the end of the race. And if you're not giving away enough, investors aren't going to be aligned, because they'll be thinking, well, you know, what am I going to get for, you know, my investment? So for me, for example, we seek to have a 3 to 8% ownership position for the money we put in, which really, you know, first check is on average $250,000. But the percentage ownership for us is important because we do follow-on investment. And, you know, we've kind of modeled the math out, and we want to make sure that we have enough opportunity to put more money into a company that's growing and a winner, right? The last thing we want is, you know, well, we were able to put in, you know, $250,000 into this company. The next round, we couldn't put anything in, or, you know, our allocation was so small because of our percentage ownership. And so that kind of dictates for an early stage fund like us, you know, why we want to invest or how much we need to own. So at this stage, you know, for us, valuation is, you know, we're looking at your growth potential, what percentage ownership we'll get. And you want to base it on how much you need, right? We always talk about making sure, and this is part of the due diligence, your capital plan lines up with your growth strategy, all right? You know, how much money do you need? What are we going to use it for? Where's it going to get us? And just, you know, some simple factors that influence your valuation, you know, the team, obviously, your prior experience and track record, you know, do you have expertise in this sector? Are you you know, do you have deep expertise in your an industry experience? Or is this, you know, you were shopping, you saw a problem, you thought you'd fix it with an idea, right? Do you have any traction? And of course, you know, revenue is always, you know, especially in B2B, is a strong indicator and of your traction and how much we're willing to assign, you know, as in terms of value for you. I did note the paradox of B2C is sometimes if you're charging customers, that can slow down your growth. And so you see a lot of models where there's the freemium, you know, we're going to give it away and we just want to have a massive user base and then we'll convert. And that revenue model for B2C was really prevalent through the last, you know, 5 or 6 years, possibly the last decade. We're seeing a bit of a slowdown in that because investors, especially when you get to the public markets, they want to see that you're actually able to sustain yourself and make money and turn a profit. Business at the end of the day is designed to turn a profit, right? And yeah, the industry that you're in. Actually, one more thing, I guess, you know, I alluded to this earlier. I'll talk a little bit about how we think about your valuation and the roadmap. And I'll do it again as an example because I think that's probably the easiest way to relate. So if you're telling me that, you know, you want a $5 million valuation for your company right now, okay? And, you know, when you do your Series A in a year and a half, 2 years from now, and maybe right now you've got $200,000 in revenue. And we'll call it, you know, let's say it's a SaaS company, right? And you're saying, you know, by our Series A, we're going to do it in the next year. Now, your average investor is going to want you to, you know, double or at least triple their investment on paper by the time you get to your next round for a lift. So it's, I have to think, what are the chances you're going to get to a $15 million valuation for your Series A? And when you look at multiples, look at the industry, and let's say, for example, the industry average is 6x on gross revenue, right? Well, 5x, just to make the math simple. That means you're going to have to get from $200,000 a year in ARR to $3 million in ARR by the next round in order to make your valuation at the Series A. So now at this point, it becomes a discussion about how are you going to get there? Or do you have a realistic plan? And in a way, hopefully you can see that kind of sets the bar really high and puts the onus on the entrepreneur, right? There's a lot of risk there. And you're kind of handicapping yourself in a way, because you're setting such a high bar to get there. And if the investor's like, look, I really love what you're doing, let's say, I'll get in. Well, then let's put in some anti-dilution clauses so that, if you don't hit your number, I'm still going to make somewhat of I'll take less of a hit than you will, right? Because I'm betting on you right now. So that's, hopefully at a high level, give you some insight into how we think about valuation. We're not focused on just where are you now and what's your revenue or and your potential and all that. It's really the math of getting from here to the next range so that I can show that the value of my investment is going up and going up by the appropriate amount. All right. So you've got an investor, you've decided you're going to date. What that dating looks like is another thing entirely. And what that means is, what are the terms of this investment? Okay, how are you going to, what's the vehicle, right? And all the thing around that. And this is part of the, I would say, part of the post due diligence process, but I've lumped it in with due diligence because I think you'll be discussing this during the due diligence process, right? So what instrument are you going to use? Is it equity? Is it debt? Is it a SAFE or a convertible note? All those instruments, that's a different lecture entirely, right? What are the economic terms of whatever instrument you're using? What we talked about, the valuation. If it's a convertible note, what's the interest rate, valuation cap, all of that. Is there what's a minimum closing amount, right? I want to know that if you're raising 1.5 million and you say, well, we need to raise at least 1.25 in order to close this round, then, I'm going to withhold my cash. It'll be an escrow until you get to 1.25 in commitments. The last thing, and we've seen this happen, is, you're raising a $1 million round, you get the first investor's check at 250, you get another investor's check and you get to about 500 and you're not getting any more money and you're like, oh, we're going to close it. And we're like, well, you were trying to raise $1 million. We base it on that premises. And now you're closing it at 500,000 is your run, and and that's probably going to shorten your runway. So the last thing an investor wants is to be caught in a situation where they put their money in and the raise doesn't get completed at what they thought it was going to be. So we're going to want to see a minimum closing amount that you think you'll need in order to make this next round work, right? Is there a closing date? Is it a rolling raise, right? We want to know the timing. And so if you have a lead investor, right, these are the details you work with them on getting to a term sheet. That's what they're there for. And what happens is when you get the term sheet, you can use that to issue to other investors to show them these are the terms of the investment. Not to say those terms can't change. It's happened. I've led rounds where, another investor comes in who's writing a big check and they want to see some different terms. And then, it gets reopened for negotiation. But generally, your lead investor will put in likely the biggest amount, and also they'll set the terms with you, get you to a term sheet, and help you get other investors.
Hey, Arden, can you maybe just speak to one point on your slide there that often seems to cause intense debate among the investment community, and that is the SAFE note. I think people used to look at it as this dirty word, but now I seem to see people using it more and more often with terms that look very similar to a convertible note. So do you have any thoughts on that? Is it now considered a tool that everyone accepts as a viable way to raise money, or is it still kind of looked at?
It depends. It depends on the investors, and it depends on their preference. Like, if we're not leading a deal and it's being done via SAFE, we'll sign on to it, or a KISS, right? It's a similar instrument. I know Panache typically uses KISS instruments to get started. It's fast, and it's well documented. But I won't lead with one. I would prefer a convertible note, and the reason for that is because exchanges for equity or agreements for equity don't actually sit anywhere, right? You could, hypothetically, and it's happened, where you don't actually do a qualifying transaction. Like, say a company decides it's going to grow organically, and that SAFE never converts. And so the investor's left hanging with, this, it's just an agreement, right? It's not a loan. It doesn't actually sit anywhere. If I do, I will say this: if you are using a safe, I always recommend the new post-money safe versus the pre-money safe. Now, I'm not going to get into all the details of that because, again, that's a different presentation altogether, and we've got limited time. But is it a deal breaker for us? No, but we won't lead with it for our fund. But every investor is different. I am seeing more of it up here. I mean, it started off as more of a U.S. thing because the safe came out of Y Combinator, and then 500 startups uses Kisses, and so, but we're seeing it more here in Canada. So yeah, we've signed on to them.
I'll just say for everyone's reference, 2 companies at the last Startup TNT Investment Summit in February raised their rounds on safes.
Yeah, Drug Bank did it on safe.
Drug Bank, so did Future Fields. They did a side deal with some investors on a safe thing. So.
Yeah, so not a deal breaker for sure. All for us, anyways. And just a few odds and ends to finish this up. Contracts, right? Things you want to see in the appendices. It might, depending on your business, this is probably less important nowadays. But if you were like a tech company that was manufacturing robotics, we might want to know, well, what's the stability of your infrastructure, right? What does your real estate lease look like? How much are you paying in overhead for that? Is it market? That sort of stuff. Employment contracts and agreements. We want to know that everybody, what are the terms that they're hired under? Letters of interest from customers, customer calls. We're gonna, that's a big one, especially for early stage. When there's not a lot of revenue, the number one thing I look for is feedback from the customers. Why did you adopt this product and nothing else? Why did this product or service get you to change the status quo for your business and what you're doing, right? So expect that especially if a fund is involved. Reference checks on the founders. We'll do those fairly extensively as well. And yeah, pretty much anything the investor needs to feel comfortable with, in order to, manage that risk reward ratio that we're managing. We're managing a portfolio. We're not just doing an individual investment. So I have to understand, how do you fit into my entire portfolio? And that could take different information depending on, the company.
Arden, do you have any advice on how to handle the customer call one? That one feels maybe the trickiest for everybody. Like, if you're doing like a $500,000 to $1 million raise, what's your advice for the entrepreneur on how to approach
if you have, well, I guess, testimonials are also good. And if there's some sensitivity, I've done, I've done calls. I would just say if you have sensitivity to reaching your customers, explain to your investor why you have those sensitivities, and find out a way that they can get feedback. Maybe it's showing them results from customer surveys, right? But what I want to see is direct primary research and feedback from your market as to why you're winning with them. Pure and simple, right? Because the entrepreneur, can talk all they want about what the value proposition is and how much they're going to, take over the world. But what matters is your market and their response to your product and your service. I'll take a quick sidebar here to this is like the competition slide. I talked about this in a podcast with Startup Edmonton. Whenever you see that, I'm on a mission to kind of change or improve that, the 2-factor competition slide where the entrepreneur is up in the right hand corner. Whenever I see that, my first question is, did you just make up those 2 axes so that you could wind up being in the top right hand corner? What matters to me is, like, are those 2 factors important to your customers? If you're telling me we're the fastest and we're the cheapest, I'm like, what if the customer doesn't care about fast and cheap? What if they just want quality? And so evidence around what's important to your customer is what matters, not what you think is going to be the value, right?
Yeah, Arden, I'm glad you made that point. I just want to make another point to all the service providers in the room. I think that this is the kind of stuff we need to be telling our entrepreneurs, because I just get a feeling that we're still teaching them to do this up and to the right curve, which frankly leads them to this conclusion: let me find 2 factors that put me in the top right.
Exactly, right.
I've experienced myself trying to make that graph for my
that can be fiction. And it's the same as the comparators, where you have like all the companies on the top and a list of features down the side and a checkbox saying we got all these and they don't. Well, if your customer doesn't care, then you can have all the features in the world, right? So again, I want to understand what makes your customer want to adopt your solution, not just over quote unquote competition, because often you'll hear, well, we don't have any competitions. No one's doing what we're doing. The competition is also status quo. What's going to get your customer, quite frankly, to get up off their ass and adopt your solution? Because sometimes doing nothing is your competition, right? So, and I just hope to outline, and this next part, I'll quickly kind of show you where does all this go, right? All this information you're preparing and things we're looking for, what does that look like at the end, right? In the end product. Because yes, most deals aren't done on the back of a napkin, as we sometimes hear about. All right, so I'm just going to pull up the other presentation and kind of show you my process. And this won't take too long. There'll be time for questions, not to worry. So what I put together for my investment committee, and not every firm may do this in this same way. So for some, it might just be an actual report. But what I do is I put together what I call a series of slide docs. Now, there's a lot of detail here, and what I do is I send this to my investment committee to read ahead of time. And when I'm actually doing the investment committee meeting, and I'll show you after this, I have actually kind of I don't go through this in detail, right? They've read this ahead of time. But what I do is add some color and talk about the highlights and the important points of each section that I want them to understand. And so it's an opportunity for investment committee to come back and say, okay, well, did you think about this or did you think about that? Or we need to see some more information about X in order to approve this, right? So this is kind of the first pass. So, this is for a hypothetical company, mortgage tech, right, in Edmonton, Alberta. And so it is, it's a little over 20, 23, 25 pages long. So we have an exec summary here. So, I will summarize for in the top left-hand corner here, so my investment committee knows kind of what are all the terms that we're looking at, right? The investment thesis is really about, how does this company fit in? Like, why are we investing in this company? What's the driving theme, that makes this fit into a portfolio? Then I can give them a bit of history and, again, the positioning. I actually got this format for positioning from April Dunford's book, Obviously Awesome. I recommend everyone to read it. It's the most amazing book on positioning because it actually gives you a process on how to do your positioning. And it's a very practical and easy read. But so this gives my investment committee an overall idea of, okay, what's this company about, what do they do, and why are we looking to invest in them. Then we go into the next section, which is the opportunity, right? I'll put a quote from the founder. I'm trying to tell a story here too, and this is where I talk about the market. This is the research, and due diligence is a combination of me looking through and synthesizing what the entrepreneur gives me, but it's also me verifying what they told me is true. So I have to do some independent third-party research through other means, right? It might just be reports I find, people I talk to, etc. So I'm kind of verifying that, yeah, generally what you're saying is making sense and it's true. And so I'll do a background on the market opportunity. I will also talk about the problem solution, and I will highlight things that I have found in my research and cite them. This is I know it's I guess it's like MBA-ish, but I'll tell you, when I was working at AIMCO, working at, in the pension fund, this is where I got this format and this style from. You are building a business case and showing your homework, quite frankly, right? And that's the job of an investment analyst or manager, because I don't have an analyst yet. So there, and then in this next, then I go into the overall market opportunity. I've done, this is my fictionalized research research in the market. Again, more background on the product. I'll talk about, like in this case, I talked about my interaction with it. What's the advantage here? Why is this special? Why do we think that they have they are differentiated from their what's out there in the market? And again, right, you can see the amount of detail, and this amount of detail is average for what I will have to do. So you can see now, hopefully, like why I need all that stuff in the data room, right? Because I need to be able to tell the story through this template and put in things like, what is your business model, right? What kind of traction are you getting? Any evidence you can give me, I'm going to weave into this story. And you'll be able to read the detail when I send this copy to you. So I've scrubbed out anything and fictionalized stuff so that, there's no secret sauce being given away. I'll get into your pricing. I'll get right into the detail because we need to understand, most importantly, I highlighted in the middle here, that you can get, to positive unit economics, right? Like you're selling me your business model and I want to know at some point, you can be profitable. Otherwise, it's hard to have a sustainable business that way. Now, again, there are numerous examples of companies that have made the public markets and exited without being profitable, and that's fine. Lots of investors will invest in those. We're not one of them, right? um, Investment management is like religion. Everybody has their own take, and ultimately, no one knows if they're right until you get to the end game. I guess in investment, it's if you're making money. But for us, we look for companies that have the potential to generate profit and be sustainable down the road. Your financials, right? So this is where it all kind of gets, put together. And I tell the story that I was talking about earlier, where you've been, where you're going with your projections. Put in the valuation and cap table details here. We want to talk about your management, right? I want to have as much background as I can. Here's the org chart sort of thing. And often the org chart will be composed of where you are now and where you plan to be. So if, additional hires, what holes do you need to fill? That way we get a sense of how far are you from having a full team? Like, what does this hiring plan look like? And does that hiring plan match up with what direction you want to go? Because if you're telling me, our product doesn't need any more development, we just need salespeople, and I look at your hiring plan, you're like, we're going to hire 10 more devs. Well, does that line up? I have to ask some questions around that, right? Milestones, right? This is the next part. Like, we want to see your progress. What have you accomplished so far? And kind of like, where are you going, right? And you see, I mean, my job is a lot easier if I can find a lot of this. Most of the time, the best due diligence I've gone through is where all this information was captured between the pitch deck and the business plan, right? All this stuff should be in there somewhere. And then I can just, copy and paste and then kind of put my own narrative in. I don't have to make up any new charts and graphs. Now it's kind of like, okay, that was the opportunity, the company, right? My investment committee, my job now is to then convince them, okay, why are we investing in this company? Let's really put it succinctly, right? I'll give them a high level, here's the high level bullet points. And this is really where the third party research comes in, the independent research, right? So for this project, I went in, I dug up, reports from large consulting firms. I've got to figure out what the story is of this market, right? So in this one, for example, financial services industry internationally is pushing to digitize and automate. Here's the evidence, here's the research, here's where a lot of the big thinkers, feel it's going and the evidence for it, right? And, again, more of that backup research. In this market, I'm trying to prove here that our market and the way this ecosystem for lending is set up is very similar to Commonwealth countries, and so it will be able to expand easily into other countries where land title systems are set up the same way, right? Again, now this is not the entrepreneur. This is me doing the research and coming up with my own story about why I think this is going to win. We can't just take the entrepreneur's word for it. This part of it, again, and again, this part of it will change depending on the industry, right, and the company. But the point is, I'm doing a lot of independent research on my own now. Now, if you can help by saying, here's some resources you can look at. I may not be an expert in your industry. So if you can help me by saying, here's where I pull my numbers from, here's some areas you can look at, the job of the analyst is to connect the dots, not just take someone's word for stuff. This is, okay, this is what they're saying. Okay, this is how I'm going to triangulate based on other information, that I'm getting from different sources. So in this project, one interesting thing, this was an examination of the trends of technology, and independently, I found this report in Deloitte and then mapped it to the product map that this company is looking at. I'm like, this actually maps pretty closely to the way a large consulting company has already said they see the future, of this industry, of digitization in this industry. So I was like, okay, that's a very good, strong signal for me.
Hey, Arden, one question kind of came up here, and you're sort of hitting on it now, which is, how much of this are you sharing with the entrepreneur? Are you even sort of like co-building?
I give this to the entrepreneur when we're done.
You give it to them.
And then the entrepreneur can then share it with other investors.
Yeah.
Okay. That's part of the advantage, I guess, of having Accelerate Fund on your team, is if we're leading, especially if we're leading the round. There are some quicker, rounds where we're not leading it, and they've already got investors set up, and we're just kind of plugging in, where I may not go through something this in depth. But if I'm leading around, I will put this out, and then I will share it with the entrepreneur, and they can share it with their investors. Yeah. Competition.
I don't know. As you had this conversation, I'm like, this is awesome, Arden. But so, like, how do the angel investors fit into this equation? Because most
and generally, because now remember, Accelerate Fund, and this is something unique about our fund, right? we're coming in. You're usually the only fund, right? Or there might be one or two others in there, but we're co-investing along with angels, right? Because our fund is an angel and co-investment fund. So part of our job is to help stimulate more angel investment in the community. And so the caveat is, I'll share this with the entrepreneur to share with other angel investors. Typically, I don't mind if this is shared with another fund. Funds typically, but they have their own way of looking at the world, right? So every fund will do their own due diligence and research. The point is, your average angel investor is not going to have the time or resources to get to this level. And our job is to help entrepreneurs unlock those angels by saying, hey, somebody's done the work here and you can look at it and see if you agree. Because, sure, you could share this with another venture fund, but they might look at it and go, well, these aren't as important to us. We look at some different factors, right? So yeah, I guess the caveat is, this is typically shared with angel investors, and that's the benefit. I don't know that it would really benefit. I mean, really, if you're giving this to another fund and they're using it, then they're just being lazy because they're not doing their own due diligence, right? And they have the resources to do so. That's their job. That's what they're getting paid for. So we talk about the competition, and this one I was lucky enough to get, one of the other, there was an actual other VC involved who was invested before and kind of gave me their take on, and they have, they're focused in the sector in property technology. So that was really great to get some validation from another investor who had looked at this already, right? This was an interesting one, like I said, when I remember, anything that might help. Well, in a discussion with, with the other investor, he pointed out that there's an analogous case of this in the insurance industry. The business model was very similar, and they managed to come out with a pretty decent exit, right? 200 million Canadian. And he saw this as being a path that, already shows that this is a path this company could follow. So of course, I'm going to put that in because it's like, this is proof that this has happened, right? If there's an actual local case study in this market out of Calgary, well, I would say that's fairly applicable, right? And so, this just helps to bolster my case. Of course, we want to do just, an assessment of the risk. And as we're wrapping things up, this is a reminder for my investment committee of, what am I recommending in the deal terms? I'll go through the team, technology, and market, because those are really the three broad areas you look at in early stage. There's not a lot of financials or ratios to look at. I call this qualitative finance. I've done quantitative finance most of my career, and I can say that I really enjoy qualitative finance because the most math I do nowadays typically is capitalization tables and dilution math. So I'm okay with that. I've crunched enough numbers in my lifetime. And then the appendices, right? This is where, I mentioned I have that due diligence checklist to show my investment committee, okay, I have covered all of this either in here or I'm comfortable that it is available somewhere for you to look at if you need to. And, certain things aren't applicable, I'll grade them out. If they're in progress, they'll be in red. And sometimes, usually the in progress stuff would be things like, it might be customer calls. Right? It might be, this is our first, we wanted to get through investment committee to get them to 90%. And then I just follow up with an email saying, yep, we did the customer calls and we're all good. There's no red flags. Sometimes investment committee will say, we'd like some more information about this before we're comfortable giving an approval. Right? So this is kind of like the first pass, right? Sometimes it works and sometimes I have to go back and get some more information. Although I will say I've never taken anything to investment committee that didn't get approved. If you do that, you're wasting everybody's time. You want to make sure that you've got this nailed down. And I've been talking to my investment committee all along the way saying, hey, could you take a look at this? Here's what we're thinking. The team has vetted it. And our investment committee is comprised of not just our team members, but several of the partners in Vancouver who are not involved in the fund directly, so that there's an objective look. And, it's not just, yeah, we really like this deal. We like the entrepreneur. Let's do it. Right? They provide that governance for our fund. Reference checks, right? So here's where I'll actually summarize the high level of what we found in our calls. And then just really quickly,
Arden, can I ask a quick question on that? How the people that are not from Alberta, the objective members, like how are they looking at the deals right now coming out of Alberta? Because I think maybe some of us are like, is a fund like Accelerate Fund ending up settling for the least bad?
Oh God, no! They're really impressed with and excited with the deal flow. I'm excited for the deal flow simply because, like I said, it means I have more work, right? And there's more opportunities. But I mean, I'll I'm very bullish on the Alberta startup community and tech community in general. And I think that's a story that needs to get out there more. I think we hear a lot of negative press about the macroeconomic situation, but those of us on the ground as investors who are working with the entrepreneurs and seeing the deal flow, and seeing who's out there doing what, it's incredibly encouraging. The number of in revenue early stage companies that are investable, even if we can't invest in them because they're out of our thesis, somebody else, could. Like, it's very encouraging. That's why I'm very positive on the environment. It's exciting, to be in this sector. It'd be very depressing if I looked across the sector and be like, there's nothing. And I mean, we don't invest just for the sake of, well, it's my job to invest. Because the fact is, as a VC, we get a piece of the carry, which means my real compensation comes on the back end. When we exit the fund, if we make our investors a certain return, anything after that, we get a piece of as a reward, as a bonus. And that's where, that's where the real upside is. And so there's total alignment. I'm not just placing bets because I like somebody, or, I have to feel like they've got potential to provide a return. And so the alignment is there. I'm not doing anybody any favors. This is about making a return for our investors, for Alberta Enterprise Corporation, and for ourselves.
Right. And I'll just mention for Kara, we'll ask Arden Kara's question after you finish up this slide. She's got a great question.
Yeah, I've got this last slide. And again, this is just any agreements or contracts, I'll probably put them in there just so they can see we've got them. And I will give you a quick look at then. So this is and then so after that, what I would, while I'm doing the investment committee presentation, right, as I'm going through it, all the slides, what I use as a guide for myself looks like this. This is more just a point of interest. I'll have notes, right, on each section. And these are just the points that I want to emphasize and walk through and give the investment committee an opportunity to ask me questions. But this is how I take them through our process and then get to an approval or not, right? So I'm not reading everything and going, because that's a lot of detail. What I've given them is not necessarily a presentation. They're called slide docs, so that they can kind of, read through ahead of time. And then this is an opportunity to just hit the highlights, ask them if they have any questions, and get a formal approval and put that on record.
Really more of a report, very visual report.
Yeah, exactly.
Okay, Arden, let's ask Kara's question. And if there's other questions coming in, please post them to the chat. Kara's got a great one, which is, what are some of the best resources for research on comparables? What are the resources you're using when you talk about, this is the typical deal size or dilution, or this is the factor on revenue that people are using in your industry? Like, what resources are you using to get that info?
Yeah, that's going to vary depending on the company and the industry. Third-party research, I would say, number one, I am looking for reports. The big four firms are all, they're pumping out reports on different industries all the time. But this is just stuff, a lot of us learn in school, right? It could be Commerce Board of Canada. It could be Statistics Canada. It could be an industry association. When it comes to comparables and deal structure, we have a subscription to PitchBook, which is probably the biggest and most comprehensive database of private transaction details on tech companies and such. And they have public companies in there as well. So it really depends on what I'm looking for. And I think that's the exciting thing about being an analyst in this space or any space, is you have to be creative. It's not like, okay, here's a dictionary to go look up, or here's the resource, now go look up the information and get it. You have to sit there and go, okay, if the trend is going in this direction, where am I looking for evidence? Right? What do I need to back up my business case? And so this isn't just a process-oriented thing. You have to think, right, as an investment manager, as an analyst, and put that business case together.
What about Crunchbase? Do you guys, I know that there's a free version of Crunchbase, but there's limited information on the free version these days. Do you pay for a subscription to Crunchbase?
No, because we have PitchBook and we've compared them, and we generally find PitchBook has better detail, and it's presented in a way that we need. And they have a great team down there. So, but Crunchbase, I have a free subscription, and I've used them as well for certain things. Again, I would never say go to one source as the only source. It's good to triangulate, right? As an analyst, your job is to verify information, and you do that by checking multiple sources and saying, okay, this is all pointing in the same direction. If you're getting divergent stories, then that leads you to then you have to investigate further as to why there's such a divergent story about an industry or a market. And again, that's part of, if you have an analytical mind, and you're investigative in nature and you're curious, that's the fun part of this job.
Yeah. Well, I think What is the? I'll just maybe for everyone's reference. I'm pretty sure PitchBook doesn't it cost like tens of thousands of dollars a year? How much does PitchBook cost? Where's Crunchbase's at?
Yaletown pays for that, and I'm lucky enough to use it. But I'm sure it's not as expensive as a Bloomberg terminal. But I honestly don't know what the cost is.
Anyway, I think I got a quote from them once, and it was like 18 grand. But um, just keep that in mind, entrepreneurs. I think you can get a Crunchbase subscription for like $300 a year. If you want to look at some quick comparison.
Yeah, I mean, if you're talking about using it as an entrepreneur to kind of put your own business case together, absolutely, something like Crunchbase would be great. But there we go.
There you go.
Thanks, Mike.
There's some for PitchBook. Anyways, maybe I'll follow up with some of the other people. I have an idea for PitchBook for us. Listen, there's a question here from Alex Arden, which is, what are some upcoming industries and new markets you're super excited about that Alberta talent is uniquely poised to address? I think you.
Yeah. And I saw use public use public libraries, like use every resource you can I think is the point. And to be a great analyst, your job is to know where all those resources are and find them. And that's the exciting part of this, of doing that. Right. So utilize everything that's out there. It's up to you. Upcoming industries. I think the way I look at the world, because our fund is what I call kind of like an S&P 500 style, where we're looking to build a diverse group of portfolio of companies across a number of sectors. And so, we're not focused only on AI. We're not focused on, some funds are only focused on certain themes. But what I'm excited about is certain things like, you start thinking about the future of work, right? And what kinds of ancillary industries are going to support that. When you start thinking about the future of healthcare, right? Again, more the at-home hospital, I think is a huge opportunity coming up, because not only because of the pandemic, but because of costs, because of accessibility. And I think people now realizing how much they can get done at home. And when you look at the healthcare systems and the direction it's going, not just here, but internationally, there's going to be opportunities to make that more efficient. What are services and industries that we all need to have, right? We all need to eat. We all need healthcare. So I try to think about themes like that. I love the alternative. I mean, Future Fields was mentioned, right? I certainly am keeping track of what they're doing. I think as an investor, the exciting thing is we have to think about the future. Right. And that's something that is, as a professional investment manager, I've been fortunate enough to work in multiple asset classes. I've done, commercial real estate institutionally. I've done public equities. And now I get to be in the early stage startup space. And I have to say, those other two are more about, running numbers, kind of looking at the past. Right. And, you're trying to project the future, but it's really based on the evidence of their accomplishments so far. Venture is really about trying to predict the future and trying to figure out and get ahead of the trends that are happening now. And so, I would say that rather than just a specific industry, we keep our minds open to where are the needs going to be. And I think we have certain constraints, like it's got to be B2B. We tend to shy away from hardware. And I know that's kind of a trope. Everybody says that. But the very real reasons is that, as a fund with a limited lifetime, logistics and supply chain risks are high. I'm not saying I'm not willing to invest in hardware, but there needs to be a scalable software component to it, or the hardware is access to data, that sort of thing. So it really it depends. We've recently, made the decision to shy away from certain clean tech technologies. So, for example, water technology. That's one area that, after doing a lot of research, I was in due diligence with a company, and when you look at the evidence, it takes a very long time to exit. It's not that it can't be done, but I was finding, the shortest exit time for a water technology startup was about 12 years that I could find, and there's some that took upwards of 20. Well, for a fund that's got an 8 to 10 year lifespan where we need to exit, our companies within that period, that's a very tough sell to my investment committee to say, odds are this thing won't exit by the time our fund closes, but it'll exit at some point and make some money. That doesn't quite work, right? So I don't know if that totally answers the question, but that's how we think about things.
Arden, I think that's a great point. I would actually say that on that note, I agree with you. I think that there's lots of opportunities in hardware, but VCs have realized by losing a lot of money on hardware plays that their funds aren't really designed for investing in hardware. And so I think it takes a little bit of a rethink about how you fund those complex hardware plays.
Yeah, and there's funds that do focus on hardware. And yes, Tim, hardware can make money, no question about it. I said before, there's no absolutes, right? And again, I want everybody to understand that, our theories, our way of looking at the world is that just that, it's our way. I'm not saying it's the right way or the only way. Everybody has a different, and I think having gotten to work in a broad spectrum of asset classes and being a professional investment manager for, pretty much all of my career, I've really gained an appreciation and respect. Oh, and Joe, yes, I mean I am going to share everything with Zach in PDFs, so you'll get everything I just showed you. But to respect that there are different philosophies. I mean, for this is getting a little technical, but when you look at an organization like Aimco, there's a reason why their public equities teams have a value team, a quant team, indices overlay. They have many different strategies because at different points in the economic cycle, different factors will cause one philosophy to be more prevalently successful than the other. And so when I look at venture, it's no different, right? Each fund, every investor is going to look for different things. If you listen to the podcast that Christina Milkey and I did, when they asked us about, this was for Startup Edmonton, and they asked us, what do you look for? What are the top things you look for in an early stage company? Christina's focus was team. And I said, well, my focus is actually the market and the business model. I want to know that there's a big market and an opportunity to actually be profitable. Because in my opinion, a mediocre team can do some work with a hot and big market, and you can always change team members. But if you have a really bad team in a really bad market, or a really great team in a really bad market, there's only so much you can do. And I think the host put it best. He said, you can fix a team, you can't fix a market, right? And that's one way to look at it. But so, I mean, all that to say is that's my particular view. Does that make me, the authority on it? No, right? And everybody with their own thesis will hopefully at some point make money with it. So the point of having a disciplined approach, though, is so that you actually can then evaluate how you looked at things. Rather, because when you're going out there and raising, I know I'm getting into more of a philosophy of investing right now, but I appreciate you entertaining that. But when I'm trying to convince an LP to invest in my fund, I have to explain to them, how do I look at the world? I can't just say, well, we go after anything that makes money. You have to have a framework and a structure, right? It's really hard to sell an investor on the, well, we kind of just throw darts at the board, or I'm good at picking winners. I know who all the winners are out there, and I will find the next unicorn. That's hard to sell to a pension fund.
Yeah, thanks, Arden. And I do, to address Tim's comment, we should point out some positive things about hardware, which is Two Hardware, both clean tech companies, raised money at the last Startup TNT Investment Summit. So
absolutely,
there's a way to raise money as a hardware company.
Oh, yeah. Well, we're invested in G2V, right? And they're primarily hardware.
And Tim used to be part of a hardware company that would raise money in Alberta and was exited. So nice work, Tim. Arden, I want to end on one important question that's always on my mind, which is VC money is not for everyone. And we all know that a lot of successful companies go big, get to where they need to go, and they never raise money from venture capital. So sometimes I think as entrepreneurs, we get stuck in this this is the path to success. I must raise VC money. Any thoughts for the group on sort of how to think about growing your business and different ways to fund your business and how VC should fit into it if it does?
Yeah, just understanding that venture capital is a very narrow model, right? And a very specific model. And you have to understand the characteristics of that before you're ready to take it on. I mean, it's for high growth companies that are going to likely need further rounds of financing and be able to achieve. Now, different funds have different requirements. Some, need 50x, 100x from their funds, from their portfolio companies. Some only need 30 to 50x. It depends on the stage, the early stage. The later stage companies only need like a 5 or a 10 because they're coming in at a lower risk and higher amounts of money. Well, the point is that it's research that path and understand, does that match your model? Am I going to be willing and able to sell this company and exit it in that 10-year time frame? Or it might be even shorter if you're coming in later in the life of a fund, right? I would say my best advice, and I've said this time and again, to any entrepreneurs who are starting out, focus on revenue, focus on your customers, build a company for your customers. Don't build a company for investors. Because if you build a great company for your customers, you will generate the revenue, and if it's appropriate, then you'll make it attractive for investors. Your first thought when you start a company shouldn't be, I need to go out and raise money, right? It should be, how do I get customers? And you might need a little bit of seed capital to start, and that's probably going to come from you and your friends, family, fools, whatever it is, that initial, the 3F round. But I would highly encourage you to think about revenue. Revenue is the best source of capital in my mind because you own it. You can do what you want with it. And you have the opportunity to reinvest into your company to continue to grow, or you can pay yourself out with it. There's nothing wrong with being small and extremely profitable at all, right? Um, so yeah, I would say venture is a very narrow slice of the pie, and understand what it's about. I often will tell an entrepreneur, like, I don't really think venture might be a good fit for your company, the direction you want to go, and that's okay.
Okay, Arden, thanks so much. Unless any more questions come in, I think we're going to end it here, but I do just want to really thank you for joining us. I learned a lot today, Arden. We're going to be sharing this with all of our investors from the Startup TNT Investment Summit and all of our participants and all of you. So this is really informative. I'd also like to say you have 2 great chances to meet Arden and other investors tonight at Founders and Funders and at our very own Startup TNT VC Pitch Night, where we're going to have 9 venture capitalists, one of them is Arden, joining us on November 5th to give a 2-minute spiel about them and their funds, and then just hanging out on Discord like we usually do at our regular TNT. So I think join us on November 5th and join us tonight at Founders and Funders. So
my pleasure. Thanks, everybody. I hope it was helpful, at least. I know there was a lot to take in, and we never did take that bio break, but I appreciate everybody's time. And yeah, I'll be on Founders and Funders tonight. I can only stay for about 20 minutes afterwards for the networking session, but feel free to reach out to me. I'm very approachable, I guess. I hope. I think you described me as the friendliest VC in the block, but I'm like, I think all of us are generally very approachable and friendly. So
yeah, I gotta be careful with those labels. Other people get angry at me when I say stuff like that. So
yeah.
One of the many friendly VCs on the block.
I appreciate that. I was gonna do like a friendly neighborhood Spider-Man background, but I can't be bothered. And I'll have my email on the PDFs that I send out to Zach. So get them from Zach, and you'll have my contact info there. Always happy to talk about investments, companies, whether we're investing in you or not, whether you're in tech or not. I'm a huge supporter of the entrepreneurial and startup community. And I'm looking forward to talking to many of you. And feel free to link with me on LinkedIn. And if you do approach me on LinkedIn, at least send a message saying that this is where you met me. I get so many requests from all over the place. It's hard to keep up sometimes. And that's not to say, that's just, a function of the job. So yeah, but if you have a message saying, hey, I saw you on this, I'd like to connect and maybe, we can talk later, feel free.
Awesome. Thanks so much, Arden. And thanks so much for supporting the ecosystem and supporting us at Startup TNT. So we'll see you at Founders and Funders later today. Have a great rest of the day. We will be sharing the slides. We should be emailing the slides to everyone. I'll talk to the organizers here. So everyone who signed up for the event will get the slides.
All right. See you all around. Enjoy the week.
Bye-bye.